Is your mortgage coming up for renewal, but you feel kind of lost on what to do? Well, maybe you do know your options, but you just want to keep your payment as low as possible. Well, either way, in this video, we are going to go through step by step on how to renew your mortgage properly, save the most amount of money while also keeping your payment as low as possible. What is up, my friends? Tom Moffat here. I'm going to jump right into it for you. So, the first step when renewing your mortgage is you're going to want to ensure that you give yourself enough time. So typically we recommend start the process 6 months out from your renewal date. The reason why we do that is because it's going to allow you enough time to shop around to various lenders while also holding that interest rate. Typically, we can hold an interest rate up to 120 days out from your renewal date. So that's the main reasons why you want to start early. Now, if you're sitting there and you're thinking, well, crap, I'm within 30 days of renewing, no worries. You still have some time. But typically, any less than that, it does restrict you from shopping around and really getting the best deal for you. At the end of the day, your failsafe is just to renew with your current lender. On that note, though, if you are renewing with your current lender, make sure you review all of the options they're presenting to you. If you don't select an option they're giving you, you're most likely going to renew into an open term. So, what does that mean? Well, basically, an open term means what it sounds like. It's an open term. You can exit out of it whenever you choose to without incurring a penalty. So, that's the benefit to it. But the downside is that the interest rate is going to be much higher. So, you typically don't want to stay there too long. So, point number two, and this one is super important. Assess your overall picture and future goals. So, the reason why this is a big point here is because there's a lot of different features to your mortgage than just the actual interest rate, which we're going to dive into in the next point. But to stay on topic with this is essentially when you are signing on to a new term, things can happen in your life, whether you choose to move in 2 or 3 years from now, or whether you want to invest and take out money from your home. Allowing yourself to have the proper setup in that current mortgage is ideal because every mortgage has their own features and rules. So, a good example of this is if you are planning renovations within the next 1 to 5 years, then you should consider going with a lender that has a home equity line of credit because you can use that available credit limit within your mortgage to fund your renovations and then convert that to an actual mortgage term. So, that's some high level strategy there, which we'll dive into a bit more with the mortgage terms in the next point. But point being, assess your overall future. If you plan on moving in the near future, you definitely want to consider more options because then a prepayment penalty can be something that knocks on your door in the near future. Or if you want to invest in the future, then having a home equity line of credit built in with your mortgage is a great option as well. So moving on to point number three, understand the mortgage features. So what do I mean by that? Well, I kind of already elaborated on this in the fact that it's not always just about the lowest, shiniest rate. There's a lot more features within your mortgage that are built in that the general public just doesn't know about. So, one of the features is portability. So, what does portability mean? Well, that just means the ability to take your current mortgage and bringing that over to your new property. So, like I said in point number two, knowing your future is key because if you plan on moving within the next 2, 3 years, then knowing you have the ability to take your current mortgage and bringing that over to the new property is absolutely ideal. Every lender is different when it comes to portability. Some lenders are more flexible with portability versus some are more strict. Some you will incur a penalty versus some you just strictly won't. There's so many different assets and components to porting that it's really important that you ask these questions up front, whether you're working with a mortgage broker or directly with the bank. The second mortgage feature that you should strongly look into is mortgage penalties. So, what a mortgage penalty is essentially if you break your mortgage at any point during your term, you're most likely going to incur a penalty. And when I say most likely, that's because you're probably in a closed mortgage. 99% of mortgages are closed mortgages. The only time you're in an open term mortgage is if you renew into an open term or if you select that because you are knowing that you're going to be moving out of that mortgage in the near future. The only time you want an open term mortgage, like I mentioned at the beginning, is if you know you're moving and shaking because that rate is going to be much higher than a closed term mortgage. So with mortgage penalties, they really vary from lender to lender and also from fixed versus variable. Typically speaking, a variable rate mortgage will have a much lower penalty than a fixed rate mortgage. That's because with a fixed rate mortgage, you're going to incur what's called an IRD penalty, interest rate differential. That's going to be a much higher calculation that the lender does versus a variable rate penalty. A variable rate penalty is typically 3 months interest. So, to give you some rough math on that, a variable rate penalty can be anywhere from 1 to 1.5% of the current mortgage balance. versus 3 to 5% of the current mortgage balance with a fixed rate. So there's quite a bit of a difference there if you look at the math. So with mortgage penalties, make sure you ask the right questions when you sign on to the new mortgage. Am I taking a fixed or variable? What's the term length? What's your penalty policies? These are all things you should be asking the new lender or your current lender that you're renewing with. The next point in the mortgage features is prepayment privileges. So this isn't penalties. We just talked about penalties. We're talking about prepayment privileges. So this feature allows you to pay down the mortgage quicker by putting more money towards the mortgage itself. So every lender is going to be different in terms of what they offer for prepayment privileges. But typically speaking, you're going to be looking at anywhere between 10 to 20% prepayment privileges. So what does that percentage mean? Well, if you look at your original mortgage balance that you signed on to, let's just use $100,000 for this example, then using that $100,000, you're going to take that percentage that your lender is offering you. Let's say it's a 10% prepayment privilege. You're going to be able to put $10,000 towards that 100K mortgage on an annual basis going forward, and that money goes straight towards principal. So that's one way you can use prepayment privileges. That strategy is called lump sum payments. The second one you can utilize within the prepayment privilege feature is increased payments. So it's exactly how it sounds. You can increase your payment by using that example of 10%. You can increase your payment by 10%. Using these in combination, you can really knock down your mortgage and save on a lot of interest over the years and really just shave down the life of your mortgage. So that's why it's really important that you ask the questions, hey, what's the prepayment privileges? Because if you're going from, say, a 10 to a 20% prepayment privilege, that's a big difference. That's a lot more money that you can put towards your mortgage. So even if you don't have the money today to put towards the mortgage, knowing that you have that feature available to you is key because you don't know what's going to happen in the future. Maybe you get that raise, or maybe you become self employed and just create a killer business. If you have more money coming in the future, at least you can allocate it towards the mortgage. So the last thing you want to check within your mortgage is whether or not you have a bona fide sales clause. So that means that you're pretty much restricted from doing certain things. So to give you an example, if you wanted to refinance your mortgage and pull equity out of your home, whether you wanted to use that equity to invest, do some renovations, or pay off some debt, you might be SOL because you're restricted from doing a refinance and restructuring the mortgage, which is within a bona fide sales clause. So the only way out in that situation is to really just sell your house, which is not ideal. And you're going to waste a lot of money. So if you're in that situation and you have to pay off a lot of debt, then unfortunately you can't pull out equity from your home and you're going to continue paying that high interest debt. That's why it's really important that you go over all of the mortgage features, not just the rate, because these features that I'm talking about here today can ultimately either cost you or save you thousands of dollars in the future. So the last point that I'll talk about here today is make sure you chat with someone that has access to multiple lenders. So not just your current lender, because that lender might be restrictive of certain features and might not be the best fit for you. They might have a higher interest rate than other lenders. Like, you want to check with multiple lenders. And the only way to do that is by talking to a mortgage agent or broker. Now, of course, I'm biased. I'm a mortgage broker, but there's a reason why I'm a mortgage broker and not a mortgage specialist at a bank. I would much rather give my clients more options than just one lender versus being at a bank and only being able to offer one option to my clients. With that being said, not every mortgage broker is considered equal. Some are newer, some are more experienced, some are lazier, some are more on top of things. So what I recommend doing is talking to more than just one mortgage broker, see who the best fit is for you, and ask these type of questions that I'm going through in this video. Another point to that too is when it comes to experience, and most mortgage brokers won't tell you this, is when it comes to a newer mortgage broker versus a more experienced mortgage broker, the more experienced one will typically have more volume with certain lenders, so they can have access to lower rates than the inexperienced broker. And also, they have those built up relationships with those lenders, which means you have higher response times and just a better relationship, which opens the door for you as a borrower. So, what I recommend doing for next steps is look at your renewal date, mark the 6 month mark out from there. And if you're within that time frame, then definitely go out right now and shop around and see who the best fit is for you, and then go from there. If you aren't within 6 months, put it in your calendar and then start the process at that point. And remember, research the broker you want to work with, check out their Google reviews, ask them these questions, and really just get an overall vibe and feel for who is the best fit for you going forward.